If you're 20 or 30 years old and have a good enough lifestyle, and if you would love to retire or become financially independent by the age of 60, all you have to do is build a retirement fund of nearly 25 crore rupees by the time you turn 60 years of age. But then you might ask me, 25 crore rupees, isn't that really big? Would you be able to build that? My answer to you is, it's very simple. That's exactly what we learned in the last video. All you have to do is invest nearly 25,000 rupees every single month for the next nearly 30 years into a portfolio which grows nearly 16% every year. Then you'll be able to make 25 crore rupees of retirement fund, and with that you'll be able to achieve financial freedom. Simple, right? Very simple actually. But then you might come to me again and ask, hey Sharique, then what is that portfolio which will actually give 16% returns? Right? And that's exactly what we are going to solve in today's video. Hey all, welcome to the 13th episode of the complete learning series of stock market investing and trading. As always, I put all the videos into a playlist, and the playlist is available here in the I button. Make sure you watch all the videos in the right order and learn really well. Let's all invest together and grow together. So we are in a very interesting journey, right? In the last many videos, we've already learned what long-term investment is, why you should be investing for the long term, and in the last very video, we also learned how much money you should be investing every single month. I hope all of you watched the previous video. If not, please watch the last video, the link to which is available here in the I button. Only then watch this video, because in the last video I've actually shown you how to operate an Excel sheet, and I've actually given the Excel sheet to all of you. And if you operate the Excel sheet well, you can actually find out with whatever your lifestyle is and what your life's ambitions are, you can actually find out what amount you should be investing into every single month. But also, in the last video, I also said that if you have some short-term goals in life, some goals that you need to materialize in the next 3 to 5 years, you should be investing into a portfolio which gives you 8 to 10% CAGR returns only. I also said that when you are planning your retirement, that is when you're investing for the next 20 to 30 to 35 years, you should actually be investing into portfolios which can give you returns in the tunes of 12 to 15 to 17% CAGR every single year. I said that, right? But when I said that, what is the missing piece there? Where should you invest? What is that portfolio which can actually give you 15% CAGR? What is that portfolio which is very safe, which can give you 10% CAGR, and which is to be used for your short-term goals? I did not say that, right? In fact, a lot of YouTubers go around and ask you to invest for the long term, but no one actually tells you how much you should be investing and where exactly you should be investing. I am going to solve that today. I have an Excel sheet again. Just like the last video, I have another Excel sheet where there is exact asset classes that you should invest into, and if you operate the Excel sheet well, you can actually find out how much money you should be investing, and from that money, exactly how much money you should be investing into which asset class. I'm exactly going to solve all your problems. Let's get into the video then. Mark your attendance, get ready, let's get into the video. The name is Sharique Samsudheen. Welcome to marketfeed. Now, if you haven't actually understood the magnitude of what I'm sharing here, that is why the Excel sheets in the last video and the Excel sheet in this video, let me tell you this. These are the kind of Excel sheets that people never share with other people. These are the kind of Excel sheets that top financial advisors use for planning stuff for their clients. And those are the kind of Excel sheets I'm giving to you for free. Maximum value delivery is what we always focus on. So, in the last video, we clearly learned how we can plan our life till retirement, and we can actually find out what amount of money we should be investing every single month. And in today's Excel sheet, we're actually going to put that amount of money that you found out in the last video, and we are going to put that amount in, and we are actually going to see what exact asset classes you should be investing into, what exact mutual funds you should be investing into, and maybe not exactly what exact stocks you should be investing into, but it is going to give a clear picture as to how much money you should be investing into what every single month. Excited? Then let's start going. But before starting the Excel presentation and learning how to operate the Excel sheet, we need to learn three things. Let's learn those first. Number one, what are the different asset classes you should be investing into? Number one asset class is equity. Now, what is equity? We all clearly know, right? Equity or stocks is basically the stocks of companies. So you basically invest into the stocks of companies and stay invested for the long term. This is equity investment. Second asset class that you should be investing into is debt. Now, you might not know about debt already. So let me take some time and explain debt to you. So debt is basically corporates and government agencies raising money from the public, not in exchange of equity or stocks, but in exchange of interest payable, right? So that is when some corporates or government agencies need some capital to do some activities, rather than doing an IPO or rather than issuing equity in exchange of money, what they will tell to people or public is that, hey, you give me money, I'm a trusted corporate, I am a government agency, so you give me money, I will return the money along with some interest. In that case, so if you're investing into debt, you're getting your principal amount back, which is your invested amount back, along with you're making an interest income or interest growth is also you're getting. So debt is basically giving out loans to big corporates and government agencies, and it is super safe. No worries there. In fact, debt investment is considered to be super safe than equity investment. Number three asset class that you should be investing into is gold. You all know gold, right? So gold is just gold. Gold has given historically good, stable returns. So you should be investing into gold as well. So these are the three asset classes that you should be investing into, whatever amount of money that you're planning to invest every single month. Also, one major thing to discuss about these three different asset classes are their risks and rewards. So if you look into the equity asset class, you can see that the returns that it can give is actually very high. It can give returns in the tunes of 12, 15, 20% even. But at the same time, risk is also high. If you look into debt asset class here, you can see that the return is less. It can give returns in the tunes of maybe 6 to 8%, but at the same time, risk is super low. You need not be worried much about risk. And if you look into the third asset class, which is gold, you can see that the returns is even lower than debt asset class, but the safety is the highest there. So if you compare rewards, which is returns, and risk of these three asset classes, this is exactly what you can understand. So the second thing that you should be learning in this video is these are the three asset classes you should be investing into, but the different instruments with which you're going to invest into these three asset classes. So the first asset class you're investing into is equity. What are the instruments with which you would be investing into equity? Number one, there is direct stock investment. Yes, direct stocks like Reliance, Tata Motors, Infosys, whatever stocks that you actually love, you can go to a broker and you can put your money into those stocks. So that is called direct stock investment. So via investing into direct stock investment, which is an instrument with which you are investing into the asset class, which is equity. Now, the second most or the largest or the most popular way or instrument with which you can invest into the equity asset classes, equity mutual funds. Now, I know a lot of you might know what mutual funds are, but if there are people who do not know what mutual funds are, let me quickly take some time and explain what mutual funds are. So, mutual funds is an investment avenue or an investment way for people who do not know how to directly invest into stocks. So, here what you do is basically you give your money to large companies called asset management companies. These asset management companies are basically run by huge companies we know like HDFC, Axis, SBI. So there are companies called asset management companies. I, as an investor, I'll give out 5,000 rupees. That is the amount I would love to invest every month. That 5,000 rupees I'm giving to asset management company. Let's say SBI asset management company. And in the asset management company, there are top executives, intelligent investment professionals sitting, and they will intelligently invest my money for me. This is what mutual funds do. I need not invest directly because I don't have the knowledge. I'll just simply give out money to mutual fund companies or asset management companies, and they will invest for me and they will pass on the returns to me, and they'll keep a small management fees for the same. No issues, right? They're taking care of my headache for me. So, in order to invest into the equity asset class, the second instrument you can use is equity mutual funds. So, in mutual fund itself, there is equity mutual fund. That is, if you actually put your money into an equity mutual fund, the investment manager, the professional there, he would take your money and put it into equities only. put it into equity investment only. So these are the two instruments that you should be focusing on: direct stock investment or equity mutual fund for investing into the asset class equity. Now let's talk about the instruments with which you can invest into debt, right? So what the instrument that you should be using is debt mutual funds. Very simple, right? These are mutual funds again, but here the money you are investing into would be invested into the asset class debt. You need not worry about what bonds you are investing into. Are you getting interest or not? Nothing to be worried about. These are very similar to mutual fund investments only. You invest into the mutual fund, you will be getting returns just like you invest into an equity mutual fund. Number 3 is, what are the instruments with which we should be investing in the asset class gold? Simple. Gold Bs and sovereign gold bonds. These two instruments can be used. Now again, do not be intimidated by hearing the names like gold Bs and sovereign gold bonds, right? Gold Bs are very similar to, let's call them gold mutual funds. These act like mutual funds only. You put your money into them, and what happens here is this tracks the price of gold. So as the price of gold increase, your investment would also increase. Nothing to be worried there. Now what is sovereign gold bond? Now, I honestly do not want to get into what sovereign gold bond is in this video. For the matter of this video, let's not get into such deep conversations. You can easily find study materials on what SGB is on Google, on YouTube, so please do that. What you can easily understand here is sovereign gold bond is another way of investing into gold. If you invest there, you will actually get returns higher than that of gold and safety exactly as that of gold. Amazing, right? So if you have understood so much, which are asset classes and instruments that you should be using to invest into the asset classes, let's move ahead. Now, the last thing we need to learn before we move ahead into the Excel sheet is asset allocation according to investment duration. Very important. We kind of touched upon this in the last video. That is, there are different types of investment durations that you will be investing in your life. Say, for example, if you have a goal that you need to achieve in the next 3 years, you need to achieve a goal. It is called a short-term goal. And if that's actually a short-term goal, you shouldn't actually take a lot of risks with your investment. Your investment should be super safe, very less risk. Otherwise, if you actually invest into a very risky asset for 3 years, what would happen is that you would invest for the first year, you would invest in the second year as well. And in the third year, just before your goal is to be met, maybe the market crashed and all your investment went down by 20, 30, 40 or even 50%. Do you want to see that? No, because if that happens, you wouldn't be able to take care of that specific short-term goal that you invested for. So my point is, if it is a under 3 years goal that you're planning for, it is called a short-term goal. And in case of a short-term goal, you should be investing, or your asset allocation should be in such a way that, asset allocation, I mean, there are 3 asset classes that we invest into, right? Equity, gold, and debt. So your asset allocation should be in such a way that you have more exposure to less risky asset classes like debt and gold. You should have very less exposure, or maybe minimal exposure to asset classes, risky asset classes like equity. That is, in the case of your investment for short-term goals, a CAGR returns that you can actually aim for is 8%. Cool? Now let's move ahead. If your goal that you're planning for, let's say maybe 4 to 7 years of period, let's call it a medium term goal, 3 to 7 years. In that case, maybe you can take some more risk. Not a lot of risk. Some more risk you can take, keeping safety really, really high. In that case, maybe you can invest a bit into equity, but still a lot of your investment should still go into debt and gold. That is, when you're planning for your medium term goals, you can actually aim for a CAGR returns of 10%. Now let's talk about some long-term planning that you're doing. That is, basically you're investing for 7 years and above, maybe for 10 years or 15 years or 20 years or even 30 years. This can be your retirement planning. This can be your maybe planning for your child's marriage, maybe your child's education, stuff like that, right? Where you're planning for 20, 30 years or 7+ years, to be very simple. In that case, since you're investing for a very long time in your asset allocation, you can actually choose to have more equity. You can actually have a lot of equity, maybe some exposure to debt as well, and some exposure to gold. In this case, So when you're doing a long-term planning, you can actually plan for a CAGR returns of maybe 12%, which can be considered a conservative approach, or maybe you can plan to have a CAGR returns of 15%, which can be called a moderately aggressive plan, or you can even plan to aim for 18 or 20% CAGR, which can be called an aggressive plan that you are, or aggressive approach that you're taking. Okay, so if you have understood so much, you might be thinking this in your mind. Okay, Sharique, you're saying this. If you're actually planning for a very short-term plan, then the CAGR returns that you should be focusing should be 8%. If it's a medium-term plan, then the CAGR returns focus should be nearly 10%. And if you're investing for really long terms, then you can actually focus for 12 or 15 or 16 or even 18%. But still, what the question is, if you have to invest 20,000 rupees every month, out of this 20,000, how much money should actually go into equity, how much money should actually go into debt, and how much money should be going into gold? And that is where, to explain that is where we have our Excel sheet. Okay, so tada, here is the Excel sheet. Let's start working. Now, this is exactly where I made a lot of sense when I said you have to actually watch the previous video. Only then you can make sense of this video, because we made a financial plan, a complete life's financial plan for Ajay Ajit in our last video. Now I'm continuing with the same story. I'm continuing the same story that we discussed in the last video. I'm actually taking Ajay's money to be invested every month, and I'm actually going to show you where exactly Ajay should be investing. Cool? So we are getting into this. So before moving ahead, again, number one, you have to watch the previous video. Number two, this is not a financial advice. Going ahead, I'll be specifically talking about or taking the names of certain mutual funds. So this is not a financial advice. Don't just close your eyes and just invest into whatever mutual fund names I'm going to talk about. So please do not do that. Always consult your financial advisor if you have one, or get a financial advisor. I'm not a financial advisor, so do not take this as an advice. This is a model thing which is built for Ajay. Ajay is happy with this. This could be, and this is not tailor-made for you. This is a better than nothing kind of a calculation. So do not just go blindly by this. A lot of names written here, specific mutual fund names that I've taken. So again, a lot of caution before you actually invest real money into this. This will work. This will actually teach you how to think. This will actually teach you how to go about investing. In fact, for example, I'm coming here, right? I'm saying here that you can actually invest 4,166 rupees to Access Long-Term Equity Fund. Going by this, don't go directly and invest into an Access Long-Term Equity Fund. You can do more of your research. You can find similar funds like this and then be the best judge and invest. Cool. Number third disclaimer I need to tell you is that last video when I gave the Excel sheet. A lot of you actually came to the Excel sheet and this was written in that Excel sheet also. This is a read-only document. Please download or use a copy. Do not go ahead and click on request for edit access. Please do not do that. The only thing you need to do is go to file and maybe click on make a copy. Click on make a copy and then you have your own copy. You can make any edits that you want, or else you can go here and click on download and download as Microsoft Excel. Then the copy would be downloaded into your system. Open it with Microsoft Excel and you can make any changes that you need. Okay, so if all that is said, then let's start operating the Excel sheet. I'm sure you're excited about this. Even I am. So make sure you learn how to operate the Excel sheet. After the video, download the Excel sheet or make a copy and then work it out for yourself. Cool? Again, this is just a model I'm showing you, right? Fine. So I'm going back into our previous Excel sheet, right? From the last video where we did some planning for Ajay. So if you remember, Ajay had three plans, three investment goals that he had. Number one was to plan and invest for a car. That was a 3 years plan that he had. Number two was to plan and invest for his marriage. And that was a 5 years investment he was planning to do. And number three was retirement planning, that is to invest till the age of 60. So these three were the investment plans that he had. So let's actually go and see in car goal planning. Since it is a 3-year plan that he's doing, as we just discussed, he should only be investing into a very safe investment asset class, which gives us CAGR returns of only 8%. So in that case, if it is actually giving 8%, he should be investing 9,066 rupees every single month. Now I am coming into our new sheet. Okay, this is the new sheet. So if you see here, what is the goal? Okay, I'm coming here into the 8% short-term goal. See, now I've actually made different tabs here for you so that as per whatever kind of a goal you have, you can come into that tab and plan accordingly. Now this one specifically, Ajay is planning for a short-term goal. He needs only an 8% CAGR. So he's coming here. What is your goal? It is buying a car, right? How many years away is your goal? It is 3 years away from the goal. And how much should he invest every single month? 9,066. Again, for people who are just watching this video, know that this 9,066 is taken from this previous sheet here, right? And this is what we discussed in the last video. Again, last reminder for you. So 9,066 is investing every single month, and see, the sheet is actually telling he should do an asset allocation of 70% into debt and 30% into hybrid. Now you might think, what is hybrid? If you look here, you can easily understand. Hybrid way of investing is actually accessed via hybrid mutual funds. That is, if you actually invest money into a hybrid mutual fund, the mutual fund manager there, according to his discretion, he would be investing into equity sometimes, he would be investing into debt also sometimes, depending on what the market condition is. It is hybrid. It is dynamically allocated. It is awesome, right? So anyway, so if you look here, 70% of allocation goes into debt, which is super safe, low returns, and the rest 30% actually goes into hybrid, which again contains a lot of debt at most of the times, and sometimes it would have, or it might have, equity as well. Now if you actually look here, you can see the returns as well. So a debt fund, I've taken an example also here. Again, this is where I said, don't go just by the example. Yes, this is something which has historically given returns. So this debt asset class is accessed via a short-term debt fund, and one specific short-term debt fund I have just taken for example as HDFC short-term debt fund. This is a mutual fund. You can go to any mutual fund platform out there. Anyways, you have opened an account with Zerodha. Zerodha has a mutual fund platform called Coin by Zerodha. You can go there, you can search for HDFC short-term debt fund, and you can easily find it. Okay, so HDFC short-term debt fund is one fund where you can invest here. It has given a not bad returns of 7.5% over the last many years, and we are investing 70% of the money there, which is out of the 9,066 that Ajay should be investing every month. 6,346 rupees goes into HDFC short-term debt fund. The remaining 30%, which is 2,719 rupees, goes into ICICI balanced allocation fund, which is a hybrid mutual fund. So if you look here, you can see that it gives a return of nearly 10% with a lot of safety as well. Which means that out of the total 9,066, 70% goes into high safety, very low risk debt fund, and the remaining 30% goes into low returns, good safety, hybrid mutual fund. So if you see here into this cell, you can see that this portfolio can give you a returns of nearly 8.25%. Very safe. A return of 8.25% by investing into very safe, low return asset classes. Super. So Ajay's plan is to buy a car in the next 3 years, for which he has to invest 9,066. He came here and put that 9,066 here. He actually understood that, okay, 6,346 he should be investing into a short-term debt fund, and 2,719 he should be investing into a hybrid mutual fund. Moving ahead, what was his second goal? His marriage, his wedding, right? So if you come here, we have already planned for it. If you see here, it is for the next 5 years. Since it is a 5-year investment plan, he can actually go for a 10% CAGR. In that case, he should be investing 9,056 rupees every single month. Let's come here. Let's go into the tab of 10% medium-term goal. I'm going there. So what is your goal? It's his wedding. How many years away is your goal? 5 years. So he's at the right place, right? 10% medium-term goal planning is what he should be doing. And what is the SIP amount to invest? Amount to be invested every single month, 9,056 rupees. So here if you see, for a 10% returns, it's a completely different portfolio. See, equity allocation here is 30%, debt allocation here is 60%, and gold allocation also is there with 10%. So we see there is a new allocation here to equity with 30%. So what we can understand here is, now the returns has gone higher, the safety might have come down a bit. Now when I say safety has come down a bit, you need not worry at all. So when equity is not something to be worried about a lot, it's just that compared to a pure debt allocation, like we saw for a 8% short-term goal allocation, maybe the risk can be a bit higher. And this shouldn't be a risk that we should be worried about. So if you see here, we have taken examples again, and the pie chart clearly tells that there is a 60% debt allocation, 30% equity allocation, and 10% gold allocation. Now equity, the fund example we have taken here is a Canara Robeco blue chip equity fund. Now, this is again a mutual fund. You can easily find this on any mutual fund platforms. So that has given, or that can give, annual returns of nearly 14%, and 30% of whatever money we are investing or Ajay is investing is being invested into this fund, 2,717 rupees. Just like that, the debt fund we are investing into here is Edelweiss Banking and PSU Debt Fund. Now you might think, hey, how can we actually select this fund? Now we would be learning all about that when the series progresses. For here, you can take this as an example. You can search for this and you can even find similar funds just like this. It's very easy, trust me. So here 60% is going, the expected annual return is 7.8%, and 5,434 rupees is actually going here. And finally, some amount of investment, which is 10% allocation, is going into gold as well, which gives nearly 6% returns, 906 rupees investing there. Total 9,056 rupees being invested every month, and the expected annual CAGR returns is nearly 9.48%, which is exactly what Ajay needs for a 5-year short-term plan, which has a lot of safety and conservative returns as well, right? Now, the next asset allocation that we should discuss here is a long-term goal that Ajay has. Now, if we go back to Ajay's financial planning, there was no long-term planning that Ajay did. Yes, Ajay did plan for his retirement, but retirement is retirement. We don't consider it as a very specific goal. Cool? A long-term goal and long-term retirement planning is different, at least in the universe that we are discussing, right? So, long-term goal can be something like his kids' education, maybe, which should be done after 20 or 25 years. Now, very funnily, in the last video, there were comments asking, hey, isn't Ajay planning for his kids' education? I asked Ajay the same. And Ajay actually said that, hey, I am not going to spend money for my kids' education. Let them actually take an education loan and let them be self-sufficient and Atmanirbhar. This is exactly what Ajay said. Anyways, for just the purpose of an example, let me assume that Ajay is also planning for his kids' education. Ajay might not like this, but again, let's just take it as an example, right? So what is your goal? Ajay said, child education. How many years away is your goal? 20 years. So he's planning from now. So kid would go for college only after 20 years, and the SIP amount he is going to invest is 5,000 rupees. So in this case, this is the asset allocation. As you can see, 65% going into equity, 20% into debt, and 15% into gold. Why? Because here, since it is a long-term investment, 20 years, he can actually take a bit more risk. So there is more exposure to equity, and see the expected returns. 13.6% is the expected returns here. And you can see the examples here. Some 25% allocation is happening in Canara Robeco Blue Chip Fund. 15% money, which is 750 rupees, is going into Access Growth Opportunities Fund. 15% another allocation, 750 rupees, is going into Parag Parikh Flexi Cap Fund. Then 10% allocation, which is just 500 rupees, is going into Access Mid Cap Fund. 20% allocation, which is 1000 rupees, is going to HDFC Short Term Debt Fund, which is a debt asset class here. And finally, 750 rupees or 15% is going to Gold Bees, which is the gold allocation here. Now, some people might say that this is a lot of over diversification, but I say this is fine. In this case, if Ajay is actually investing 10,000 rupees, then considerable amount of money is going into each fund. Now, this is something not Ajay is doing. I'm giving this sheet to you. So I thought I'll keep so much of diversification. You can remove some funds and remove some diversification and allocation if you do not want to. Okay, again, let me tell, do not just download this and just follow this investment. Just like I said, you can play around, you can change the fund names, you can change the allocation, you can maybe increase equity allocation, you can increase debt by reducing equity. It's all up to you. This is a playing field I am giving to you. You can go around, work around, change things and make a plan for you, either by yourself after learning from me, or you can use someone's help. It's all up to you. Anyways, this is how Ajay is planning for a long-term goal. Now, what is remaining? His retirement planning is remaining, right? So let's go back to his financial plan. How much is he planning to invest every month for retirement? For retirement, we did say that, right? He wants to invest into a asset class which can give 15% CAGR returns, because he's planning to invest for some 30-35 years. So he's okay with going with a bit more risk, which can give 15% CAGR returns. And with that, he knows he has to invest 16,420 rupees every single month. Now, where should he invest this? That's exactly what we are going to see here. Now, again, he had a choice, right? He had a choice either to go via the 12% CAGR route or a 15% CAGR route, and both could be worked out here as well. If he's actually going with a 12% CAGR investment allocation, he can use this tab, this tab. So if you are a person who wants only 12% CAGR, you can use this tab. But here Ajay actually wants a 15% moderately aggressive long-term plan. He's actually going with this tab. Okay. If you are very conservative, then you can go with this. Ajay is going with moderately aggressive long-term plan. Cool. Anyways, he comes here. What is your goal? It's retirement. How many years away is your goal? 32. What is the SIP amount to invest? 16,420 rupees. And tada! This is the asset allocation. 90% into equity and just 10% into debt. See, understand the fact here, right? See, he's investing for a very long period, so he can have more exposure to equity and less exposure to debt. Now, there is some more points to be added to asset allocation. After we discuss the Excel sheet, I'll come back and tell you how Ajay will actually intelligently plan out asset allocation in the 30 years of investing. So just wait out a bit. So if you look here, one very intelligent thing that we have done here is when Ajay is investing 16,420 rupees, the initial near 12,000 rupees is going into ELSS funds. Now, what are ELSS funds? Equity linked saving schemes. This is what the full form of ELSS is. Now, if you are a salaried person and if you are paying tax, you would know that in the income tax rules, there is something called as Section 80C. That is, according to Section 80C, if you are investing up to 1,50,000 rupees every year into ELSS mutual funds, then on this 1,50,000 rupees, you need not pay taxes at all. That is, whatever your total income is, you can reduce 1,50,000 rupees and the remaining would be your total taxable income. You need to pay tax only on this remaining income. So keeping that in mind, when Ajay is investing actually for his retirement fund, the initial 14,000 rupees every month is actually going into ELSS funds plus some debt funds for super safety. Since Ajay is a person who's actually investing 16,420 rupees, the initial near 14,000 rupees is going here. And on top of that, the remaining 2,420 rupees near approximate is what is going into other mutual funds. All of them are equity. As you can see, all the other mutual funds are equity mutual funds. But before that, the initial 14,000 rupees, out of that, see, the initial 12,000 something is actually going into all equity fund and nearly 10% is going into, see, nearly 10% is going into a debt fund. And the exact debt fund we are using here is HDFC short-term debt fund, and the ELSS funds, you can actually easily read out the names here. And on top of the initial 12,000 into ELSS funds and nearly 10%, which is 1,642 into a debt fund, the remaining, which is nearly what 2,000 something rupees, is being invested into other equity funds as well. Understood? Now let's say you are a person, according to your life planning, you actually got an answer. How would you plan? You come here, you go into retirement planning and say you planned your life and you actually understood that you should be investing 50,000 rupees every month. See the magic here. If you are to invest 50,000 every month, again, 4,166 should go to an ELSS fund. Another 4,166 should go to another ELSS fund. Again, a 4,166 should go to another ELSS fund. Now, the question is, why are we diversifying between 3 ELSS funds? Again, diversification is always good. So again, the first initial 12,000 near you are investing into 3 ELSS funds, then 10% of whatever you are investing is going into a debt fund for safety. Really good. And all the amount on top of that is what is being invested into other diversified equity funds with exposure to large cap, mid cap, flexi cap, mid cap. Everything is there, right? In fact, Parag Parikh Flexi Cap Fund even invests into US equities. This is a super diversified portfolio that we have designed for Ajay, which takes care of his tax liabilities as well, tax savings as well, which takes care of aggressive long-term growth as well. In fact, it has 10% allocation to debt also, which ensures that there is good enough amount of safety also. So I hope this is super clear. So putting in everything, we can see that this can actually give a return of nearly 17%. That is the expected growth of this portfolio. How amazing, right? He only wanted to grow at what, 15%, and he had to invest 16,000. In fact, if he's actually going by this portfolio, this can actually give him 17%. He need not even invest 16,000. Maybe If he is investing 16,000, it would actually grow more and he can actually have better plans taken care of. Now that is it. Almost everything is taken care of. Even if you have a under 3 years short-term goal you can come to this tab and plan it out. If you have a 10% CAGR focused, say a 5, 6, 7 years goal, then you can come to 10% medium-term goal and sort it out. If you have a life goal, which would take another 20 years, you can come to this tab, 12% conservative long-term goal, bracket no illnesses, and plan it out. And if you are to plan for your retirement and invest for the next 20, 30, 25 years, and if you want 12% CAGR returns, you can come here. The asset allocation has more debt, more gold. You can come here. This will take care of your income tax requirements as well, right? ELSS investments are present here also. Or else, like Ajay, if you want 15% CAGR returns, then you can come to this tab. Now, if you actually want to have even more returns, then what can you do? You can actually come to the very last tab, which can actually give you 16 to 20% plus CAGR returns for your investment period. Now, how is it done? So come here. I'm again taking Ajay's example, retirement. How many years away is your goal? 32 years. And for example, we are taking SIP amount to invest is 50,000. Just like the previous case, the initial 12,000 would go into ELSS funds. Very important, right? Your tax should be saved. The next 5,000, which is 10% of your investment amount, is going into debt fund. See where the remaining amount is going. It is not going into mutual funds anymore. Earlier, everything else was taken care just by mutual funds. This is where a lot of times I actually mean that just by investing into mutual funds, almost all of you can reach financial freedom. But here, the remaining amount is not going into mutual funds. It's actually going into a direct stock portfolio. Now, how can you make this? By studying about companies, by doing fundamental analysis, researching about them, and actually making a basket of stocks or a portfolio of stocks that you actually love and you actually think that would grow in the years to come. So if you can actually make a portfolio which can grow at 25% returns because you studied, you're putting in so much effort, you would definitely, or you should definitely do better than mutual fund managers. In that case, it can give 25% returns even, right? Or 20% returns. Whatever you think it can give, you can put here and maybe allocate more money or all of the money or over and above your tax savings and your debt fund investment into this, and then maybe your portfolio can give 20% returns. If you study well, if you do fundamental analysis, if you can pick your own stocks which can do great, then you can even have a portfolio like this which can give 20% CAGR. And with such a portfolio, you can accelerate your journey towards financial freedom, or you can make even larger retirement corpus with which you can have a luxurious life after retirement. So that is it. I've actually taught you how to operate this Excel sheet. Now it's up to you. Download the Excel sheet. Make sure you either make a copy or download it and then work it out. Use the previous Excel sheet from the previous video to know how much money you should be investing, and use this Excel sheet to know what asset allocation you should be doing and probably figure out what all funds you should be investing into, and if possible, start investing today is what I would say. Now, before closing the video, I have two more things to say. Number one is something I already promised you I'll be explaining in the end, which is a bit more complex thoughts about asset allocation. Now, there is a very famous saying in the market, 100 minus your age should tell you your asset allocation into equity. The rest you should be investing into debt. For example, your age is 30. In that case, 100 minus 30 is 70. So 70% of your investment should go into equity and 30% should go into debt. And maybe you age and you turn 40 years of age. And when you turn 40, 100 minus 40 is 60. And when you turn 40, then you should change asset allocation. 60% should actually go into equity investment and 40% should go into debt investment. So as you age and age and age, what would naturally happen here? Your exposure into equity would reduce, which means that your risk would reduce, and your exposure to debt would increase, which means that your safety would increase. How amazing, right? So I know I went into the Excel sheet and easily explained it, but in very, very, very practical terms. I know what Ajay would also do is the fact that I'm coming back into the Excel sheet again. For the very first 10 years, maybe he would go with a 15% moderately aggressive long-term plan. For the next 10 years, he might actually invest into the exact same portfolio you see here. And after 10 years, or after 12 years or after 15 years, when he ages, he might feel that, okay, I might actually increase my debt exposure. At that time, he might stop investing into this asset allocation and he might actually come into this plan where he has more asset allocation or exposure to debt and gold as well. You understand? And maybe at the time when he is 50 or crosses the age of 50, he might even come and start investing into a portfolio like this, where there is a lot of debt and gold allocation compared to equity. So my point is, asset allocation is something which can be dynamically changed. So as you age, make sure that your exposure to equity should be reduced, your exposure to debt should be increased. Now, this is where I keep on saying that when you are investing for the long term, you should have the right education. You should have the right perspective. You should have the knowledge, right? You have to say you start investing today in a 15% moderately aggressive long-term plan. Make it a point after 10 years, you actually reduce your equity exposure, increase debt. If you do not do that, at the age of 55, there is a huge crash in the market. You might actually see your hard invested, saved, invested, earned money going down, and you wouldn't like that. So please make sure that you learn really well and do, or you get the right consultation and do, or see, I always say this, right? When we feel bad health-wise, we actually go to a doctor. We feel good in consulting a doctor, but in terms of personal finance, we never go to a finance doctor. Right? One, there are a few. I don't have a business or service regarding that, but there are people out there. Make sure they are good and maybe reach out to them. It's absolutely okay doing that. This Excel sheet, I believe I have given you a lot of clarity and perspective when it comes to how much money to invest and where to invest for the long term. So the last thing to discuss before bidding goodbye is the fact that you might ask me, hey Sharique, why not investing into FD? Why not investing into Provident Fund? Why not investing into NPS, National Pension Scheme? Let me tell, our aim is not to invest everywhere. Our aim is to achieve our life's ambitions and to achieve financial freedom and to retire rich. Retire at one point and not worry about money anymore. I'm not saying retire and then do not work anymore. I think I'm a person who would actually keep working till I have my last breath, right? But at one point, I want to stop worrying about money. So if that is the why, if that is the objective, then this would help you, or this would be the best way to do it. By investing into equity, debt directly or via mutual funds, this is the best way to do it. Going via the FD route, giving you 6% CAGR. Your investment plans would go for a toss. You might have to invest for another 200 years, maybe, to reach your goal. So FD does not make sense at all. So my whole point is, do not or stop investing into FD. Why do you think Ankur Warikoo always keeps telling, hey, don't investing into FD? I am actually giving you numbers, not just words. I'm showing you numbers and the story behind why you shouldn't be investing into FD, which is giving such lower returns. So the same goes with your PF, NPS, not the best way to invest. This is actually, if you're a knowledgeable person, if you can put in the time to learn and know about this, then the way that we discussed in this video and the last video is the best way to do it. That's it. That's it from my side for today. So yeah, I hope this video made a lot of sense. Then the next job to do is learn more about this. Maybe learn more about picking great quality stocks, learn about fundamental analysis, how to do fundamental analysis, and let's learn how to value stocks, and let's learn how to create a great stock portfolio. Let's learn how to invest into mutual funds and whatnot. Let's learn those in the coming videos, and by the end, you would be knowledgeable enough to create a long-term portfolio for yourself, which can actually take you to the moon. Cool. So that is it from my side. Make sure, as always, you hit the like button, share the video with as many as people, invite them to join the community, and go into the comment box down below and ask all of your doubts. So that is it from my side for today. Let's learn, invest, trade, and grow together. See you in the next class. Bye-bye.